Good morning. As you know, Pranitya is always doing some kind of educative event for clients. And in this series of first expert who were invited for this today's discussion is Mr. Chintan Haria. He is a principal investment strategist at ICICI Prudential Asset Management Company. He himself is a chartered accountant, and of course, he doesn't need much of an introduction, but the industry knows him well for his long tenure and his expertise in the Indian markets. So, without further delay, I would like to start interviewing him. And first of all, thank you, Chintan, for accepting my invitation.
No, thank you, sir. And,
And
it's an honor and pleasure to be the first one to be able to speak to you.
yeah,
Thank you
that's
so much.
that's what we are trying to do. So, Chintan, my first question too will be looking at Indian current equity market. How do you see growth going ahead? Rather, the market going ahead with the growth offered here, because last 2 years, market has not really delivered any returns.
Yeah, so interesting. I was about to say that let's go back a little and then it will help us to look at the future. So if we look at post-COVID, there was a lot of money which got printed in the world, and all asset classes actually did very well because of the printing of money. Namely, gold, silver obviously is what we saw, but across equity markets, housing markets, commodity markets, that's essentially the flow of money which led to the significant rise across asset classes. Specifically on India, if you look at it, of course, 2020 March to 2024 September was a great period. Investors made a lot of money. And obviously, domestic investors in a very big way came into the markets. SIPs supported the market. After that, like you mentioned, sir, 2 years it's been a bit of a consolidation. And that has got to do with a few things. One, if we look at starting point of August 2024, India was at 24 times P. When I say India, MSCI emerging market,
Yeah.
which is essentially MSCI India markets, which global investors track. And the MSCI emerging markets, which includes China, South Korea, Taiwan, etc., was available back then in August 2024 at about 10 to 11 times. So India was at 24, they were at 11, including India 25% weight. And that gap meant that India was overbought, overvalued, and probably a little bit overowned as well. And when these three conditions happen, you need a bit of consolidation or correction. Correction hasn't happened in India because of the domestic flow, but the last 2 years of AI or artificial intelligence flows meant that South Korea, Taiwan did what they did. They became from 10-12% weight in MSCI emerging market to almost 22, 23, 24%. And India has been down from 24 to 11% weight in MSCI emerging market. So there's a big difference that we've seen in terms of how the world has moved. And today, if I look at it more importantly and look at the next 2 to 3 years, clearly India stands out. We've seen FI outflows, we've seen undervaluation in large caps for sure. And if we look at from a overall perspective, valuation wise, India versus let's say South Korea, Taiwan, US, if I look at it, India becomes a little better. And next 2 to 3 years in terms of growth, and we'll speak about growth a little later also, I'm sure, India stands out because there is absolutely no other country in the world that I can see which has population growth, a young population of 28 years. And also, if you look at every sector and segment, there is growth possibility across. And the world is supportive for us because we are one of the beneficiaries of what could be a China plus one strategy. So clearly next 2 to 3 years, India should bounce back. India should become more relevant. Last 2 years have been a washout because of all the money that has gone in artificial intelligence. And the spike in oil prices kind of pulled us down from March. But if we look at it going ahead, we should be fine in terms of the overall outlook for the next 2 years.
Yeah, and I think most of these things have come from outside of India than within India.
Correct.
That may be.
Correct.
Maybe second question could be, I know your call on silver was bang on. How do you see, like when we make a heat map, you see different sectors outperform every year. Leaders are different. So, what are those? How do you see next 5 years? Which sector can help India really grow from here?
So yeah, it's interesting. If we look at asset classes and the way to make big money is when you have under ownership, under valuation. And if you look at from an under ownership, under valuation and under performance perspective, silver was there, gold was there 2 years back. Today it is essentially India, if I look at the world, right? Indian large cap is under-owned, undervalued and underperformed in a meaningful way. And among sectors, sir, as you mentioned, India is in a beautiful situation right now where If I look at every segment on every sector, and even if you look at the commentary which is there in the current quarterly results which is coming out, there is a little bit of growth that is there coming across all the sectors. So India is not a one-trick pony. We are not
Yeah.
like Indonesia, Australia, even South Korea, where a single segment is leading. We have a diversity because it is a domestic economy. So those are the strengths, and I'm sure all your listeners or viewers have known about the strengths of India, that it's a domestic economy, young economy. But more importantly, every segment has representation now. So you spoke about sectors. If you look at if India is growing from current $4-5 trillion GDP to maybe $8-9 trillion GDP, financialization is the word,
Yes,
and
yes.
of course you
We
and
are
I have been big
part of.
beneficiaries of the financialization drive, and that itself will mean, and by finance I don't only mean capital markets. If you look at insurance segment also, insurance segment will grow meaningfully. Capital markets, wealth, exchanges, everything to do with financial markets. So banks and their subsidiaries. So that grows. And generally when foreigners will come back, that's the segment which they will invest in the first way. Because generally when any FI looks at any domestic market or external market to invest in, to buy growth, they look at the financial services sector. Apart from that, if I look at energy, I mean, we all know obviously that India is
Yeah.
going to transition from the current 34-35% urbanization to maybe not as high as China. China is 66% urbanization. But we will move towards maybe 45-50% urbanization. And when rural to urbanization happens, you'll need more air conditioners, you'll need more cars, etc. So energy in every form will be the core growth story and growth engine for India. And if we are going to become the manufacturing superpower of the world, I mean, China is of course right up there, but if
Right.
we are having the building blocks, then manufacturing also picks up. So we have a unique situation where manufacturing, energy, financial services, and of course with 145 crore people, healthcare is always going to be in the in thing. So there are many sub-themes
Drivers.
which can actually do well in India, which have a growth map for next 5 to 10 years. So it's not a single sector, which is what makes India's economy and as a fund manager extremely interesting, because you don't have to pick from handful of stocks.
Yeah.
You have a wide variety of stocks in which you can make money, and that's where I think the growth of the industry should also be good, because those who are able to pick the right stocks will deliver alpha to the investors.
Okay. Yeah, coming back to the strategy, like, market has rewarded growth for last 3 years and value has just left behind. A lot of large cap stock today we can see are mouth-watering valuations available. How this shift happens in the market, like from growth to value or value to growth, and is time ripe for value to play its role?
So I think today, if I look at it, the segment which has underperformed the most in the last 5 years is actually quality. So if we look at 2012-13 to 2021, uh, quality did extremely well, and by all the quality stocks were essentially high ROC, high ROE businesses were well bid up, they were over-owned, and they were trading at 70, 80 times. Now, most of them have kind of consolidated or corrected because growth did not keep pace up with the valuations. Apart from quality, of course, large cap, and within large cap, as you mentioned, sir, value has come in many of the large caps, but it is where growth is missing right now. So value performs when growth comes in those value stocks.
Right.
And so last 2 years have been weak for value, yes, but prior 4 years were very good. So these cycles keep coming. What is essential for investors is to stay invested in a set of funds or a set of themes
Right.
which they have invested for the long run, and if they underperform for 1 or 2 years, it should not be a worry. Those who invested in quality say 4 years back, that was wrong timing, and they got hurt. Today if you're thinking of quality, may not be a wrong timing, not that you will immediately make money, but over the long term you can. Those who invested in small and mid caps 2 years back are today probably not as happy as those who invested 5 years back. So I think these cycles keep coming across segments, across themes. But today, if I look at it from a market perspective, the mega caps or the large caps, just a number, since you mentioned I'm a chartered accountant, so
Yeah.
numbers will come naturally. The top 10 stocks in India, which is the top 10 Nifty stocks in India today, account for only 48% of the Nifty 50. This is the lowest ever in recorded history for the last 30 years,
Contribution is
which is essentially means normally they are about 60, 65. So
Right.
essentially they have underperformed so much, mainly because of foreign selling, and otherwise also the market has kind of moved on to the other stocks. So each one of the segments in the top 15, 20 names will have their core reasons why they've underperformed. But these are good stocks, they have pedigree, and probably they can do well. So that's the low hanging fruit in the market. And that's where I think the investors can look at the large caps. Having said that, India is a wider variety. You'll have mid and small caps also. So from a theme perspective, quality should do well. Value, you have to have patience, probably maybe another couple of years before it does well. Growth is very narrow right now. So when you look at growth, sir, and last 2 years, very few stocks have made money, unlike 2021 to 24. And that narrowness has probably brought out the difference between many of the funds that people may have invested, right? Some funds have done very well, some funds have not done so well. So because it's a narrow market, but I do expect that maybe in a few quarters, we'll have a little bit more broad-based rally. But yes, there is overvaluation in some segments which we should be cautious about.
I see. So India, in terms of growth, has fallen from 8% to 6% and maybe around 6.5%. When and how do you see we can go back to 8? Is there any chance we go back to 8 and 8 plus? And if yes, what are those drivers which can take us to 8% plus type of growth?
So, is there potential to go to 8, 9? The answer is yes. But that 8, 9 also has to have an external market or external world which probably is supportive. Currently, we are in a world where because of aging or because of higher interest rates, the growth itself has become anemic. Just one statistic which is again interesting. In US, the savings rate has come down from 6% to 2.5%.
Yeah, that's dramatic. Yeah.
And that essentially means that future consumption is going to get impacted if the equity markets don't do well there.
And they are the largest spenders.
Yeah, they are the largest spenders, and the current equity bull run there is probably supportive of the consumption there. But their savings rate is down to 2.5%, which means that if the equity bull run in US kind of narrows down, slows down, or has a reverse, a reverse cycle, you may end up seeing consumption go down significantly in the world's largest consuming country. China obviously is having its own internal issues, and China actually is a big exporter. So the export engine is taking care of China. But if the world is slowing down, and China obviously is exporting a lot, then if the pricing comes down, then for India's external growth, it becomes a little bit of challenging. But having said that, domestic economy will remain strong. So for that 8%, the world has to fire. And that 6.5 also in a world which is not growing at more than 2.5 is not a bad number. The good part is we are seeing certain amount of inflation coming back. We were in a cycle where essentially inflation was very, very low, and the WPI inflation and even the CPI inflation was low. Not for you and me as consumers, but if you look at the, for the producers, it was a little low, and hence the numbers were not coming. So when we look at equity investing, we should look at nominal growth rather than real growth. Real growth is important, but from an equity returns perspective, nominal growth is what is relevant for us.
You mean earnings growth, you want to say?
I meant nominal growth means inflation plus real GDP growth. So real GDP is 6.5, and we had inflation in India which is 1.5%, let's say. So we were growing at 8-9% nominal GDP last couple of years. If that moves to 12, 13, 14%, because of inflation being 5%. Generally in India, 4.5-5% inflation is what we see. We normally is what we see. So 6.5, maybe 7% we touch with a greater efficiency, and maybe 5.5% inflation. So 12% nominal GDP growth. That's excellent from
that usually mimic the earnings growth.
Yes, that will bring in earnings growth in the ecosystem, and there is a chance that some companies will do better than the others, and if we pick the right companies, that's where the investors' return comes. So, equity market investing is all about picking the right stocks which are growing, and ultimately the growth comes from the growth of the GDP. If the GDP is not growing, then creation of a return in equity is not going to be easy. But India has the potential to grow at 11 to 12% nominal, which is essentially real plus inflation, real GDP plus inflation, which is where we are very comfortable for the next 5 to 10 years of India's growth. India should be the big growth engine from the world equity. Today we are only 4% of the global equity market. We are at 4 trillion, 4.5 trillion global equity. US has touched 75 trillion. So one more word while we are at this, many investors, and maybe you have a question ahead on international investing, I'm preempting that. US is 70-75% of the global equity market cap right now, which is probably the highest, it is the highest ever. It is the highest ever, and I think that's where the big scare is, that the world is so polarized that you have some companies which are larger than India as a market cap. You have 75% of the global market cap residing in US. So from an international investing standpoint, investors should be a little bit more cautious. I don't know what your personal view is, but as I see it, we are in the advanced cycle from an international investing side. If you invested 4 years back, you made good money. Probably it's time to take some profits off there and invest in India large cap or India multi cap, India flexi cap, because that's where probably the risk reward is much more favorable today.
Okay. Then after this answer, I have to modify my question maybe. So on this international thing, there is a FOMO factor, and even the largest of the family office I meet, they are in a thinking about how to address this
Correct.
whole thing. The investing limits are over from where you can invest from domestically, and globally also LRS and gift city have hardly any option.
Yes.
Gift city is meant for inbound and outbound. That's what I
That's
see.
right. That's
Looking to preserve the forex reserves and all. So and again on the other side, we are just 3-4% of the global markets. So we are not addressing 97% of the investing universe in a way. So how do you address this? How far we should feel bad we are not there in the international market
So
investing?
that is true that there are many segments of sectors. In fact, uh, I think 5-6 years back when we launched the strategic metal and energy, just as a theory, we were like, we don't have gold mining companies, we don't have oil exploration companies, global oil. So you brought both of them together in that fund, right? And that helped investors to participate in gold mining, etc. Similarly, today, if you look at it, there may be pockets, right? In 2022-23, the European defense did well. But it's about selecting the right ones and then making money. Today, most people, and not just today, in the last 7 to 8 years, my experience has told me, people get attracted to international investing after it has done too well. Which may be true for India as well, that after something does well, like PSUs were available cheap 2018 to 2023, investors started looking at it only after it outperformed. So that's probably a global phenomenon of chasing returns. But globe, like you mentioned, sir, has lot of opportunities. In fact, there are some, let's say, pharma companies in US which are available cheap today. So obviously, as large family offices, you can go the route of ETFs, or you can go the route of buying stocks to the extent of the LRS limits, etc. But the fact is, there is a wide universe. But let's remember, there is also wider options, and to pick from those wide options, you need expertise. So probably if you build that expertise, you can lend it to them in terms of international investing. But one thing for sure, please do not get invested in something like South Korea, two stocks, 56% of the market. TSMC, which is the Taiwan Semiconductor in Taiwan, it is about 56% of the market. No recommendation otherwise, but the fact is, these are such large parts of that market. If you are investing in that market today, you are taking a very large concentration risk. So you need to probably have diversification, and in that diversification, you should look at funds or segments which are cheaper also. So one thing is sure, there is only one mantra in our life: valuation cannot be ignored whenever you are making any investment. Today, if we look at it, some of the tech names, some of the semiconductor at an index level are 70-80 PE. That's something we should avoid in terms of long term. It can hurt us in terms of our performance.
According to you, maybe technology, new businesses, new development, where the exploration is only possible outside of India.
Yes.
Then only you can go out, and because you are taking currency risk, market, there is a external market risk, and then the company risk.
Correct.
Right? You're doing that.
Correct.
So unless there is something unique offered from outside, and that's where you should be
And
looking at.
there are unlimited examples like innovators of drugs, right? Lots of drugs that we use in India, or medicines that we use in India, the therapies, they are available outside. They are not from India. So obviously, Indian companies there are many Indian API companies which support those companies in terms of the API that they give or the active pharma ingredient. But the innovators are there. They make it big when they know there is a significant innovation which happens. So there are, but you need a lot of effort. Probably you need 10 times more effort there than what you did in India. Yes, in terms of selecting the right one.
And in your observation, how much of allocation usually you have seen people are given to the offshore investing? Generally, I am not asking any.
So if effectively, maybe if you ask me this question 5-6 years back, it was not major. People were just probably looking at diversifying within India from mutual funds to PMS, AIFs, and probably credits, etc. But in the last 5-6 years, I have definitely seen as family offices have become more sophisticated, and obviously they've probably hired people who are from the industry. They've gone on to have international investing. Of course, mutual funds were available, domestic mutual funds which were investing outside till the time the limits didn't get over. And that's how the limits actually got exhausted. But typically 10% to 15% is the maximum that I've seen. I have not seen anyone go bigger. Gold, silver, people may have gone bigger, but otherwise,
That's again a
international
good
investing,
10-15%.
10% is, yeah, 10 to
Is a
15% is par for
generally
course.
industry norm as of now.
Absolutely, absolutely.
Great answer for that. Thank you. Of course, I again repeat your call on silver is still in mind. As a asset allocator, we need to look at all the assets
Yes.
and the multi-asset category. Do you see still role of silver and gold is intact? It has lost its relation with dollars. Even the geopolitical has not impacted or not helped gold to go up. So how do you see this equation change because of any particular reason, and how this will pan out? Do you see still role of gold and silver in your portfolio?
Yeah, so in the interest of time, I'll keep it short,
Yeah.
but otherwise, gold and silver, I can speak for hours. But if you look at gold essentially, just quickly, 30 seconds, gold is generally got relations with the money printing which happens in US. So if you plot the M2 versus the gold price, it's effectively the same. So 4 years back, M2 was much higher because money printing had happened over the last 15 years, while gold had not moved for the last 10 years before that. And then today, if you look at gold, it's about 22 crore kgs of gold which has been mined so far. And at 4,000 odd dollars, you come to about $30 trillion of gold available in the world. That is more or less, let's say, matching the kind of money that has got printed over the last few years. So, gold 4 years back at $1,200 international price was under invested in terms of its relation to M2. Today, it is more or less at par. So, it may consolidate a bit. There is no real trigger. Plus, international buying is not happening in terms of, let's say, sovereigns were buying it big. Although China data which came for June was quite strong in terms of their gold buying because gold has corrected. So probably we may not see much fall in gold, but the kind of rally that we saw, if people expect 50, 100% return, that may not happen.
Yeah.
On silver, of course, unlike gold, silver gets consumed. Silver is still one of the best conductors of electricity that we know, and a lot of applications. And for the sixth year in a row, the demand is going to be more than the supply. There's one website which your viewers may actually look at it if they have time, silverinstitute.com or .in, Silver Institute actually. There you can see the demand supply of silver, and sixth consecutive year it is demand is more than supply. I do believe that with this 50% fall, the excesses or the froth which was there is probably out. Now, will we see the retracement of this $200 in silver? I do not know. It's very difficult to predict. But currently, at the price at which we are, definitely it calls for some allocation to silver. If someone has made money and booked profits at a higher level, definitely they can look to start replenishing that. If someone has been zero on silver and is probably looking at it new, go slow because it can be a metal which can actually be very volatile, and you may not have the appetite for such a volatile metal. But nothing to say that silver's demand has fallen and silver supply is not keeping up pace right now. That's the problem. And silver supply is more or less cornered by, again, China. So we need to be very careful of that as well. That silver can spike anytime if the supply continues to be lower than the demand.
Yeah. Chintan, on the economy side, maybe last two questions from my side. So, we have seen India is mostly a consumption economy. On our export side, we always seen services are driving the whole exports. Do you see we are moving to the government efforts which have been put in will make us manufacturing-led economy eventually? And do you see we are exporting and we already acquired a lot of outward FDI has gone to acquire companies outside. Will that help India making a manufacturing hub, and will that help in generally in terms of valuations? Because services deserve lower multiples and manufacturing deserves slightly higher multiples.
Yes, so if we look at it, so in the last 50, 60 years, most Asian economies which have grown to be where they are, the larger ones, be it Japan, South Korea, Taiwan to an extent, it's much smaller, and China, of course. What has driven them is manufacturing in terms of their global prowess. And luckily for India, we have the engineering strength. I mean, brilliant engineers available at talent-wise. We have now the land, labor, capital effort. Money is not a problem for India because most global corporations wants to set up shop in India. And in terms of our electricity infrastructure, port infrastructure, there is a serious effort to make it efficient. With all of this happening, entrepreneurial spirit was never a problem in India, as most of your viewers who are listening right now, they've created great businesses. So it's entrepreneurial spirit plus government focus on ensuring that manufacturing in India picks up. And I do see that globally also more and more. I mean, who could have thought we export defense equipments, we export electronic equipments, right? Yes, we don't make the core electronic chips, etc., which Maybe in some time in the future we'll do. But at least there's a lot of exports which are happening across segments which earlier we were not there. And more importantly, a lot of import substitution. We used to import, let's say, the TV panels or the mobile phone panels, etc. A lot of it is getting made in India now. So both import substitution and export promotion is going to lead to India becoming a much bigger phase in the manufacturing. Automobile cars, auto ancillaries. I mean, India becomes a hub, natural hub for all the exports which are happening. Electric vehicles also we are exporting, right? So while competing with China in all of this is difficult, but we are making an effort to be there, and we will. India is not a very large economy, right? We are 1/6 the size of China.
Yeah.
So any incremental fillip we get there is actually a big add-on.
add-on.
And in that, what you mentioned about the GDP growth, I think if we add this external market and the external capture of the global market, because Europe is slowing down.
Yes.
Europe is becoming too expensive for Europeans to manufacture. We can get some part of that share. And hence I'm extremely positive on this entire manufacturing theme. And in fact, whoever I speak to, they are looking at smaller towns, etc., where manufacturing is actually booming. I mean, a company in Rajkot, for example, doing business for Apple, otherwise. I mean, it's something which probably is just a sign that India is arriving on the global stage, and we do have the prowess, and now hopefully the logistical infrastructure also.
Correct. Maybe a second last question, and very people are waiting for it. Though role of FI has gone down over a period of years,
Yes.
what will make them come back to India?
Yes, so FI holding in India has come down from 22% to 15.5%. It's the lowest since 1990. India now is, I think we have, so about the 470 lakh crore market cap that we have, roughly 65 lakh crore is only about FIs, right? So it's significantly lower in terms of its impact, and I would say mutual funds and banks, etc., have become larger, right? So this is not 2008 kind of scenario where we were small, they were large, and the global financial crisis impacted us, which is also good. India will remain less volatile, India will remain steady. When will they come back, your question? I think when this entire artificial intelligence led narrative kind of mellows down, and also the conflict in Middle East, if the crude prices stabilize or lower, both these contribute significantly to India becoming a better and attractive destination. And of course, at some point of time, if you look at it, the earnings growth in India, because last 2 years earnings growth was a little slower. But if earnings growth also comes back, then all three are supportive of FI is looking at. I think in the last 3 to 4 months, if I look at the numbers, there has been a definite improvement in terms of the scale, right? They were selling a lot.
July has been big positive.
Yeah, so they were selling a lot. Now at least the selling has stopped and some minor buying has emerged. That may be a trend change, that may not be a trend change, but at least the force of selling should get low, because India is clearly significantly undervalued relative to the emerging market basket, and that also gives a lot of comfort. And also if you look at it from a political standpoint, from a population standpoint, from and of course monsoons which were expected to be bad, they've also kind of stabilized. It's sporadic that it comes in spurts and goes, but at least it's not as bad as what originally we had thought. Water table is also there. So everything is aligning towards ensuring that India as a market does well, and eventually that should also bring in foreigners into India, because capital is there in the world and it will have to chase growth. We are seeing a lot of, let's say, large deals, 2-3 banks in India being bought by Middle East, Japanese banks. They are essentially playing the India growth story. You're seeing the FDI happening. Foreign portfolio investors are not coming in India because probably majority of the, they were underweight Asia and money went there. And at some point of time, it will come back to India, because India's weight in the overall basket has also come down significantly.
We are underweight at this stage. For everybody is underweight.
Yes. So India was overweight by 7%. Now probably they've kind of rebalanced it, and hence we are seeing slowly. But I think if you look at it, technology in India, banking in India, oil and gas in India, pharmaceuticals, all of them have good quality companies which FIs would want to come and buy at some point of time. It's just that currently they are not looking at it. If artificial intelligence stocks have given 200% return in a year and India has given zero, who will look at India for the time being? So it needs a shakeout in AI for India to see foreign investors. They will come back, because India is the long-term growth story. Currently, of course, there is no immediate trigger for it. But if AI collapses and Middle East crisis kind of ends, then definitely we will see some bounce back. So investors, from an investor perspective, being patient, investing right now, not necessarily staying on the sidelines, those who stayed on the sidelines investing in flexi cap, multi cap, large cap kind of mandates, I still don't think mid and small cap in India is cheap enough for us to go in a big way. But not waiting on the sidelines for long is what I would recommend investors if they have been so. And of course, you are the best judge
Yeah.
into what they will do with their portfolios.
So as you know, we only have large and investors and family offices, but still I think there is a skepticism in their mind, and they are still sitting on the sidelines. What will be your message? Maybe the last question from my side.
Yeah, so sitting on the sidelines for the last 2 years was a brilliant idea in retrospect. But sitting now, if we talk 2 years down the line, may not look like such a good idea. So if you actually sat aside with some cash or with some debt holdings, etc., which was originally meant for equities, now is the serious time to think about allocating. It could be today, it could be after 2 months, whenever you do. But now is the time to rethink the strategy, and I'm sure with your inputs, they will be able to take the right call. But given India's underperformance, given the relative undervaluation, underperformance, under ownership, it makes sense to start at least investing what you are otherwise waiting for. Otherwise, uh, on the way up, then it becomes difficult to invest again. You want to wait for that lower price, right? I mean, if you look back March 2026 when the war broke out, or
Correct.
March 2025 when the previous fall had happened, markets were available at a much cheaper price. But then at that point of time, it becomes difficult to invest. So always having a path towards investing, be it through SIPs or be it through STPs, is a better way because no one can time the top, no one can time the bottom.
Perfect. Thank you, Chintan, being first in the Market Expert series. It was a great discussion, and I think my clients will really get out of this whole discussion. Thank you for
Thank you
coming,
so
and thank you for all your
Thank you so much, sir, for all the respect that I have for you. It was a pleasure, and I'm very happy that I could add value to your investors. Thank you.
Thank you, sir.